Good day, ladies and gentlemen, and welcome to our webinar on support and resistance trading, sponsored by LegacyFX. LegacyFX is one of the world's leading providers of Forex and CFD trading, and they are a regulated provider. When you trade with Legacy, you can use the most current version of the MetaTrader platform, the MetaTrader 5 platform, brought to you by MetaQuotes. It gives you financial market analysis, advanced charts, technical indicators. It's a user-friendly interface. You have many choices. You can download the desktop version. You can use the web trader. You have an Android version for your mobile device and an iOS version for all of your iOS type devices. When you use MetaTrader 4 and MetaTrader 5, you can develop your own black box trading system right on the LegacyFX trading platforms. So if you want, during class, you can go to www.legacyfx.com and download a demo account. There's no credit card, no deposit required, and you can see how incredible the LegacyFX MetaTrader 5 platform is. You can also use it to follow along with our classes today and use the advanced charts right on the Legacy platform while we discuss support and resistance trading. Now, Legacy's philosophy is very simple. They offer a focused and personalized service that makes trading logical. They have competitive trading conditions. They're a fully compliant broker. They offer free trading signals and simple and easy execution of your trade. They offer the most advanced education and learning center with a wide range of tutorials and courses, live webinars like today, periodical market research, and financial trading tools. And today, all clients with LegacyFX get access to the auto chartist trading signals and alert system. It is one of the most well-known scanners and trading alert signals in the marketplace, and it's yours for just trading with Legacy. Now, since Legacy is a regulated provider, I am required to give you a risk warning. So let me read that, and then we'll move on with our class. Trading at Forex and contracts for difference are complex financial products that are traded on margin. Forex and CFDs carry a high level of risk since margin can work both to your advantage and your disadvantage. As a result, CFDs may not be suitable for all investors because you may lose all of your invested capital. You should not risk more than you are prepared to lose. Before deciding to trade, you need to ensure that you understand the risks involved, considering your investment objectives and level of experience. If you're not sure, please seek independent advice if necessary. Now, today's class is being recorded. And if you wish to see a recorded version of this class, you can do so in about 24 hours by using the same link used to attend this class today. Or when investing.com has had time to edit and clean it up, on the investing.com website where you register for today's class, you'll be able to find it under the Education tab and then Webinars on Demand. So let's get started talking about support and resistance trading. Now, in today's class, I'm going to use the term security. I might say the euro, I might say Facebook, I could say Google or Bitcoin, but I'm not talking about any specific instrument. I'm talking about all publicly traded financial instruments in which an open market exists. I also mix up the terms investing and trading. Now, we know the difference. Typically, an investor takes a long-term position while a trader takes a much shorter-term position. But in any case, the concepts today are equally adept. But the fact remains, we know the difference, but it gets very, very boring saying trading, 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 trading. So I intermix the terms. Now, whether I'm doing a seminar, a webinar, a conference, one-on-one meetings with new traders, wherever I go, people seem to ask me, what should I buy today? What should I sell? What will prices be tomorrow, next week, or next year? Now, wouldn't trading be easy if we knew the answers to these questions? But alas, I don't have a Ouija board, and I do not have a crystal ball, and neither does anybody else. So if you're attending this class in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you early. It doesn't. Knowledge, education, experience, and controlling your risk is what trading is all about. However, if you're attending this webinar with the hopes that technical analysis will improve your investing, that it surely will. So today we're going to start talking about one of the most basic concepts in Forex trading. Now, it doesn't matter what strategy you want to employ. Doesn't matter what type of trader you are. Doesn't matter how long you've been trading. Doesn't matter whether you're trading Facebook or Bitcoin or the euro. Everybody should have support and resistance levels on your charts. Basically, these are some of the crucial steps that everybody should take when they're looking at a price chart. Just like having trend lines on your charts, seeing the most current price, and support and resistance lines. Now, there's many different ways to get support and resistance. And strangely enough, everyone seems to have their own idea on how you should measure support and resistance. Now, the concept of support and resistance forms the basis of Forex technical analysis. Forex traders look to buy at or near areas of significant support in an uptrend, and they look to sell in areas of significant resistance in a downtrend. So you may have heard the old cliche, buy low and sell high. But how do you know when you're getting near a low price to buy, and how do you know when you're getting near a high price to sell? So the easiest way I can explain to you support and resistance is using an elevator for an example. Imagine you step in an elevator. Below your feet is your floor, and it is currently supporting you. Doesn't matter whether you stepped on that elevator on the 35th floor or the 92nd floor or the first floor. The floor under your feet is what's holding you up. If the elevator wishes to move up, you need to break through that ceiling above your head. That is your resistance. Now, if the elevator turns to move down, the floor is your resistance because you got to jump hard on that floor to break through it to get to the next level lower. And what was your support? It was that ceiling, because every time you jumped up on the floor, you hit your ceiling on the head, you fell back to that floor again, and eventually you broke through it. So if you think of support and resistance as the floor above your feet and the ceiling above your head as price is moving, you can get a pretty good understanding of what this concept is. Now, once you understand the concept of support and resistance, you have to understand where to put it. So if you imagine that price is moving up, it's the steps on the ladder as price is moving upward. And when price is coming down, it's the steps down the ladder. Now, when you know what floors are above your head and what floors are below your feet, and you can analyze price movement, you can start making sense out of how price is moving. You can start making sense out of price action. Because if we stay with our elevator example and think about the elevator moving up and down. Now, you get off of the train downtown, get out of the train station, it comes up into the ground level of a low-rise building. It's a big building, covers a whole block long. And you stop every morning to get your coffee at the coffee shop or the Starbucks sitting right in that building. From there, you usually walk over to the sandwich shop and pick up your lunch for to go. Sometimes you mill around. You may sit there and have your coffee in the courtyard. You may do anything. And then you leave to go to your office. Well, today you get a little bit interested. You have some free time. And while you're sitting there drinking your coffee, you notice the far end of the floor are these two big chrome or brass elevator doors, and they open, and there's nobody in there. You say, you know what? You decide, I'm going to be adventuresome. Take your coffee, step in the elevator, but because your briefcase in one hand, coffee in the other hand, you can't touch the buttons. You don't have a free hand. The door closes, and the elevator moves up. Goes up one floor, two floors. What's pushing you up? Your support levels, floor after floor after floor. You broke through that first floor, you went up to the second, you went up to the third, and the door opens on what it says R for roof. Now, the door's open, and you can see it's a huge, beautiful roof deck. It's more designed for the smoking area. You see all these outdoor balcony doors with little tables and chairs for people to go out and smoke. You see a little place for people that work in the building to sit and have their lunch. You see all kinds of vending machines. Okay. So, and the door closes, goes down to two. It opens on two, and one of the cleaners gets in the floor, and you notice it's this dark wood, beautiful, professional offices, but you don't see any signs to the offices. You don't see any other people. The elevator goes to one. Door opens again, and you see the same dark wood and dark, luscious carpet. And then you see all the signs. There's an accounting office. There's a lawyer's office. There's an optometrist's office. There's all kinds of professional offices in there. The elevator gets back down to the ground. I know this is a boring story. The elevator gets back down to the ground. Door opens and you get off of it. Now, you're a pretty smart cookie. So since we understand supply and demand is what moves price, but you're not a broker, you're just a worker bee. So you're going to do some quick analysis in your head. You realize it's early in the morning. So most of the employees haven't come to work yet. You're going into your office very, very early. That's why you're wasting time drinking your coffee. So you did see the cleaning woman. So now you can figure out while you're sitting there having your coffee, you see all these people pile into the elevator. So you're playing a little game with yourself. How much is it going to stop at one, or is it going to go up to the roof? Is it going to stop at one and go up to the roof? Going to stop at one and two and go up to the roof? You say, I bet it's going to stop at one and come right back down. Why? Well, your analysis tells you everybody got on an elevator is just coming to work. And so they're going to go up there, drop off their briefcase, their bags, their jackets, their backpacks. Then they might go up to the roof and have coffee or smoke. You've also analyzed that the second floor is floor two of the internal offices, but you have to go through the office on the first floor to get to the private stairway upstairs to the elevator. So what have you done? You've done technical analysis, and you've determined how price should move and when price should move through these support and resistance levels in its move up or its move down. So this concept, my explanation might have been a little bit boring, but it's an important concept to understand. Now, one of the things to remember as opposed to our elevator example is that support and resistance levels are not exact finite numbers. Oftentimes you will see support and resistance levels that appear to be broken, but just as soon find out that the market is just testing them. So we can't, too many people want to draw these numbers on their charts and say, okay, the support is at 149. So if price hits 149, it should bounce off and move up. But it really isn't, because to get these prices in reality, there are many ways that we can achieve support and resistance. My preferential way is what I call eyeballing. And this is the best way to determine your support and resistance levels. And this is going back and looking at historic prices and looking at in the past where price has made significant highs and significant lows. Now, it's a manually intensive method, and it takes time to draw on all the currency pairs that we trade, but in the long run, it'll pay off. So as price moves up, each of these levels in historically are drawn forward on your charts. So let me pop up a chart. Let's go to my teaching chart, which is the Euro US dollar. And you can see all of these levels. The only levels that are of any importance are the levels above and below price. Now, when you drew them on, and once you draw them on your charts, they don't go away. They stay good forever into the forward in the past. Like, see this one? This was drawn back when the euro was trading at 108, 109, 110. When the euro makes it back up here again, that level and the other levels will become significant again. So I'm not going to go back and draw them all on my charts already. They've been drawn on my charts and they're just go forward. But they go forward as price moves back into that level again. And of course, there's always new ones, old ones, less important ones, and I personally color code them. My color codes let me know how long they've been on the charts. They let me know how significant that price was. So for instance, this blue line here, that's a support level that was drawn way back 6 months ago. It's a level that price had hit many times as the euro came to its lower level. In our more recent trading, back on the 7th and 8th of this month, look how important that level held. Now price broke through it, but it came right above it. When it moved back up and it came back down, look what held it. Okay. Again, here, price moved up, came back down. So this level, though, came from way back when. It came from historically looking at prices. Same thing with this one. Okay, but look how important that price level has been in our most recent trading. Now, price has moved back up from the euro and has been trading back up all day. And look what happened. It hit this price right here, which is an old support level, and it's holding. We got a push in the high only up to this old gold level, and it came back down. That doesn't mean it can't go through this automatically. Now, too many traders want to get stuck on these words support and resistance. When price is moving up, something holds it, it's support. When price falls down and goes through it, it becomes resistance. All you have to know is it's a significant price level in that asset's journey. So for instance, perhaps we saw a stock. Okay. That stock, historically, every time it got up to $42, it fell back down. You look last year, the year before, it's never been higher than $42. Well, today it's trading at 42, or it's trading at 41.95. Well, would you be buying into that market or would you be selling? If it's never been able to break $42, you're going to be ready to sell. If you're in the market, you would most likely be taking your profit because that was a significant resistance level to that price. Now, every time it fell off that $42, it would fall down to about $39, $39.50, and then bounce back off and gravitate back to that 42 level. So it usually traded between $39 and $42. Never higher than 49. Now in its history, it's not way below 30, but it always seemed to gravitate back there. That tells you something important in that movement of that asset. So we can see on my chart here, first of all, these levels I drew on here, which are in the dashed line, are significant to the pound dollar, and they still remain significant today. We could extend them forward. But if you notice, I drew what I call my dead man zone. I took my important level and I added a few pips above and a few pips below. And then I drew my red lines on, because these are alert zones. They aren't finite numbers. But we can see in the movement since all the way back in March, we can see the pound fell below, came back up, stayed in this level for all this trading. Now it is moving back down to this level for it to come pretty close to that level. And I might be looking at a price in which to re-enter the market. And look at this, how it stayed in between these two significant zones. Here on this chart, the pound Canadian dollar, we have our significant resistance zone right here with the two blue lines. We could use set our target point when we get the breakout triangle based on the next resistance level. And we can use this to analyze or determine how we might want to make a trade or understand price action. Now, I don't expect you to remember all this. So if you look on your screen, okay, there's a part that says handout. There's a little thing on your screen that says handouts. I've put together a guide called the Support and Resistance Indicator Explained. Okay. Everything we're talking about is explained in detail. There's no registration, there's no cost, there's no nothing. Click the little download button. It's a PDF. It'll download it to whatever device you're using, and then you can move it around to wherever you'd like to read it later. I've also given you the technical analysis guide from investing.com. Now, support and resistance are a prime part of technical analysis, but this resource guide covers the entire field of technical analysis. You can download it, use it whenever you want in the future, research it, use it as a resource guide, but they're only available in this live class. So if you don't download them now, you won't be able to get them later. Now, one of the most common ways to get your support and resistance levels, well, let's talk about the others, is one is through pivot points. Pivot points come from a pivot point calculator. Okay, they are mathematical calculations. Okay, I don't use them. Some people do use them. There's nothing good, bad about them, but I use eyeballing because I want to look back at historic prices. Pivot point charts calculate based on a mathematical equation and will give you the current support and resistance levels, 3 above and 3 below the current price. And they're constantly changing and updating. So as price moves, you have to use your calculator, update them, or you can use a chart that's constantly updating them. Okay. They give you, and for our type of trading, sometimes they work very well because they're giving you very short-term support and resistance levels. Now, if you use those in combination with eyeballing and you have two significant levels and they're the same price, that reinforces the point. Because remember, markets ebb and flow. They go up, they come down, they move sideways. So we need to make sense out of these ebbs and flows. Okay. Now, like I said, I use the traditional eyeballing. And I'm going to put together, I put together a short presentation on how to get this. And then we're going to go on and talk about how to apply this in a trading strategy. So let me share with this little presentation. And then we'll take a look at using support and resistance in your everyday trading.
Okay, so here we have the daily chart of the FTSE 100, and as you can see, currently the price is up at the 7,300 level and has spent the last couple of months around the 7,000 level. Now, to demonstrate how to identify and plot support and resistance areas, I'm going to scroll back on the chart to the last time the price was in the same region as it is now. This way we can use the support and resistance areas we plot from the previous price action to see if they have any significant impact on this price action that's happened over the last few months. So I'm going to draw two red lines, one above this price action and one below, very quickly. There we are. Now we want to scroll back and find the last time that the price was between these two lines so we can use it to identify and plot the support and resistance areas for this price region. So if we scroll back, we find that the last time price was in this particular region was sort of December, January to August 2016. So in order to start plotting the support and resistance areas, we first need to identify where they are. And as I said in the video previously, we need to spot the points where price has had a significant reaction. And to do this, we want to find where price has either been heading in a particular direction, has stopped and reversed, like here, or where it has stalled for a significant amount of time before either breaking through a particular area or reversing. So this area here, for example. And to plot these areas, I'm going to take my circle tool and I'm just going to first pick out all the reactions that I can see on this particular region of price action. So as I said before, I'm just picking out all the reactions where price has either reversed or stalled, and I'm just highlighting them so I can see them more easily. Fantastic. Okay, and now to plot the areas, I'm going to take my line tool and I'm going to work my way down the chart until I come to a reaction point. So the first reaction point I come to is this one here. And I want to encapsulate this reaction with the two lines. So I want to take the highest point the reaction occurs, and I want to try and place my line at the lowest point where the reaction occurs. And then once I've done that, I can delete my circle. So here we have our first support and resistance area. And then all we're going to do is work our way down the chart, picking out these reaction points, their lowest and highest levels. Another one here. Another one here. This one has more than just the one reaction from it, which is fantastic as it gives this particular area a little bit more weight in future use. As we come down a bit further, we've got this one here. To there. Actually, this one could probably come a little bit lower and encapsulate that reaction as well. And then we've got one down here. To there. Got another one here. To there. And then we've got another one here. To there. And then we've actually got another one here to there. And then we can delete our circles, as all of these reactions should now have been encapsulated in the areas that we've drawn. So that one has, yep, yes, 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 and yes. Now you may have spotted.
Okay, now, it seems like it's a very manually intensive, time-consuming, boring thing. But see, once you drew all those lines on, yes, it is the first time you start trading an asset. But once you've drawn all those lines on, they go way into the future. So when price stays in that area, you never have to draw them on again. When price moves above that area, below that area, you have to draw the next set on. But then once they're on, wherever price moves, you've got it covered already. Now, there are other types of support and resistance. There's dynamic support and resistance that comes, like, say, from price above a moving average or below a moving average. Then we have support and resistance that come from retracement levels. Because when price is moving up, making its steps in its uptrend or downtrend, it's forming these retracement levels. Now, a lot of people mix up the 50% retracement with fibs. Okay? Now, Fibonacci levels also are a way of getting support and resistance, but 50% level actually comes from Dow theory and says that a market will tend to retrace the prior move by about 50%. Now, Fibonacci levels give us the 38.2, the 61.8. They've combined 50% and 23 based on the previous move. These can be used as support and resistance. The more times the price has hit support or resistance, or the more times different methods of putting support and resistance on your chart, the more valid or the more important that particular price level is when all those prices come into conjunction. So we have many different ways. Again, my personal favorite is eyeballing, because number one, it makes you work with price. It makes you feel that you and the price movement and the charts are part of the same thing. It gets you to understand the personality, and you understand where those levels come from. They're just not mathematical calculations. And you'll find as you're trading, you'll get used to interchanging the words support and resistance. You'll get comfortable with the levels you draw and how you draw them. But now that you know the basics, it's time to apply the basics, but extremely useful technical tools to your trading. So we want to make things easy to understand. So we divided the trade, how to trade support and resistance, into two really basic strategies. These are called the bounce and the break. Now, support and resistance can be added directly onto your charts. I do them every day, and I always check them every time price is moving. And they're a very, very good way to check your risk reward ratios and to check your target limits. Because if you've calculated that your trade needs to go up 18 points for you to break even, and you set your target and that's 20 points, but you realize there's a significant resistance level between there, maybe you need to recalibrate your risk reward ratio, because there's a good chance that price won't miss it. The other thing is when you're looking to set your stop loss, okay, and you have a significant resistance level fairly underneath, right under your price, okay, you can use that because maybe you need to put your stop loss a little bit higher up in order to make your risk reward ratio. Or if your next support level is way down, and where you're calculating your stop loss, there's nothing that's going to stop that price from falling, maybe it'll help you. But this is just, I don't ever make any trading decisions or look at a chart without support and resistance. It's not part of a strategy, it's just part of my being. Okay, just like I don't look at a chart without trend lines, and I look for chart patterns because I'm a price action trader. Now the bounce is one way to trade support and resistance on their own. And as the name suggests, one method of trading support and resistance levels is right after the bounce. Many retail forex traders make the area of setting their orders directly on the support or resistance level, and this waiting to trade for their trade to materialize. This is a really bad thing to do. A lot of traders will look at their charts and see a significant support level, and as price is easing down, they'll put a buy order at that support level. Well, again, remember, this is a zone. It isn't a finite number. And also, sometimes price will fall right to that support level and then go right through it. Sometimes it'll bounce off of it, go up a couple points, and then turn around and go through it. Okay, so just arbitrarily setting a buy order based on a support level when the price hasn't reached that level can make a big mistake. Now, this may work at times, but this kind of trading method assumes that the support or resistance levels will hold without price actually getting there yet. You're making a big assumption. So you might be thinking, why don't I just set an entry order right on the line? That way, I am assured the best possible price. When playing the bounce, we want to tilt the odds in our favor, and we want to find some sort of confirmation that the support or resistance level will hold. For example, instead of simply buying right off the bat, we want to hold for it to bounce first before entering our trade. If you've been looking to go short, we want to wait for it to bounce off resistance before entering. We want to see that physical bounce before making any trading decision. But you see, if you enter your order before that physical bounce and it never hits that level and then turns around and goes, it's going to execute your order automatically whatever that price has reached. So you have to wait until price comes down to that price, to your support level or your resistance level, whichever you're looking at, and then bounces before you even set up your order, because otherwise you're going to be in trouble. So by doing this, you avoid those moments where price moves fast and breaks through the support or resistance levels. From experience, catching a falling knife when trading Forex can be really bloody. But then we can use that support and resistance level to set our stop losses, our order price, and our limit price. So remember, in a perfect world, support and resistance levels will hold forever. McDonald's would be healthy, and we'd all be flying around in jetpacks. In a perfect Forex trading world, we could just jump in and out whenever price hit those major support and resistance levels and earn loads of money. But the fact of the matter is these levels break and break quite often. Because remember, they're just stepping pools. They're stepping points. They're the stairs up and down as price is moving. But there's no guarantee that elevator is going to stop on that second floor, no matter how much probability you figured out. You may know it's lunchtime. All those workers have been in that office all day, and that elevator's hardly gone up to that roof. Well, the probability is that elevator is going to go to that roof because somebody wants to take their lunch or somebody wants to go on the balcony and smoke. But it may be 5 more runs and it just keeps going up to the third floor and down to the ground level without anybody going up to the roof. I don't know why. Maybe today they were walking the steps because it was cool and comfortable. So there are also ways to play what we call the break. We have the aggressive way and the conservative way. So the aggressive way, it's the simplest way, is to play the breakout, is to buy or sell whenever price passes, and this is the word, convincingly through a support or resistance level. The key word here is convincingly, because we only want to enter when price passes through a significant support or resistance level with ease. We want the support and resistance area to act as if it just received a karate chop. We want it to wilt over in pain as price breaks right through it. Now, the conservative way is just like we were talking on the bounce. We wait for it to react first. Now, I've put this together in a little PowerPoint slide show for you, and I'm going to share it with you. And there is no narration here, but I've written all the steps right on the slides. So if you watch and just read it, it's a very short presentation, but it was easier for me to do it in a pre-set up way so that I have all the slides set up for you. So take a watch for that. It only goes on for a minute or two. And it's a very easy strategy for trading support and resistance. So I'll replay it for you so you can watch it again step by step. We've gone over the major types of support and resistance and how I use them as indications of market conditions. Levels to look to buy and sell from, levels to define risk, and as a framework to understand what the market has done, what it's doing, and what it might do next. When you combine a solid understanding of support and resistance levels with price action and market trends, you have the triumphant of trading. Support and resistance does not have to be confusing. We can mix and match any methods and create a healthy amount of price levels that we can trade. Always practice makes perfect. So make sure you test out these methods using a real-time demo account right on the LegacyFX trading platform and make sure you get them down. But once you start adding them onto your chart, you'll find out they give you a great deal of knowledge. You combine volume and support and resistance levels, and you can really predict exactly what price is about to do. So thank you very much for joining us and have a great trading week. Bye now.